Welcome to 3 and 3. Today we're going to be talking about growth, inflation, and monetary policy. So thus far, US GDP growth for the first half of the year has been slower than 2023. Going forward, the US economic outlook for growth for the second half of 24 is quite mixed, with some predicting even slower growth and others expecting moderate expansion. In general, economists forecast a deceleration as Federal Reserve interest rate hikes, diminishing pandemic savings are seen as dampeners on consumer spending, which has been the main driver of consumer growth. As you can see from this chart, there are three pathways. The baseline, which is the green, which does reflect a slowdown. A golden era for labor markets, where the labor market continues to do strong. And then the black line, which looks at persistent inflation and geopolitical conflicts, which has the slowest growth going into the second half and also bottoming out in 25 and finally reaccelerating into the second half of 25-26. Inflation. Inflation is a concern, and we have continued to reiterate that inflation is stickier than consensus wants us to believe, as it may be challenging, we think, for the Federal Reserve to get inflation all the way down to its 2% target. The general consensus is that inflation is slowing, but a tight labor market and rising wages may delay the pace of this decline. And as you can see, this is the inflation chart going back to 2017, the CPI versus the employment cost index. And the employment cost index has been pretty sticky, and that's leading to a higher consumer price index as consumers have more discretionary income to spend on goods. So it looks like probably most of those rate reductions are going to occur in 2025. As you looked at this chart, you're looking at chained GDP price index, the consumer price index, and employment cost index. And you're starting to see that slowing that the Fed is looking for happening right around 25 and 26. And that slows to the 2% target. So monetary policy. The market consensus for rate cuts in 2024 has undergone significant revisions throughout the year. We came into the year thinking there was going to be potentially 5 rate reductions. The Federal Reserve has lowered its official guidance to only 1 rate cut now of 0.25% in sometime around December. However, some Fed committee members still believe 2 cuts are possible, indicating some lingering optimism. As you can see from the FOMC's latest dot plot, the overnight rate starts right around where it is today at 5.25% to 5.5%. It dips down slightly to that 5%, 5.25%, and those are the voting members. And then as you go into 2025 and 2026, that's where most of those actual rate reductions start to occur. So there are potential risks. The election, the biggest event of the year for America, is undoubtedly the November 5th election. As the election draws near, and it promises to be one of the closest and most divisive races in U.S. history. And also this big tech heavy influence. The concentration in the U.S. stock market is high and has been increasing in years. This means a small number of companies hold a large share of the market share value. The key players, again, being the Magnificent Seven. Some of those, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, are a lot of the drivers of this concentration. Thank you for joining us for 3 and 3.